Alright, so let's dive into the latest updates on Keir Starmer and the potential tax changes on income from shares and property. It's been a pretty hot topic recently because Starmer made some remarks that are stirring up conversations about what he really means when he says working people. So yeah, there's a lot to unpack here. Let's get into it. Okay, so starting off, Starmer has hinted that there might be tax increases for individuals who earn primarily from things like shares and property rather than regular wages from a job. Now, this point about people who rely on income from assets instead of an actual day-to-day job is what he's emphasizing when he talks about working people. His remarks suggest he doesn't necessarily include those who make most of their money through assets in his definition of the working class. Interesting, right? I see where he's coming from, and it certainly has some serious implications. Next week's budget announcement is expected to touch on key areas, including inheritance tax and capital gains tax (CGT), which is the tax you pay when you sell assets like shares or property for a profit. The government is facing pressure to clear up its position here because, remember, there was a manifesto promise to avoid raising taxes on working people. People are watching to see if this promise will still hold. It's a pretty tense situation because defining working people isn't as straightforward as it sounds. When asked about this, Starmer explained his stance a bit further, especially around people who both work and have income from assets. Basically, he told Sky News that those with significant income from assets like shares or property wouldn't fall under his concept of working people. Starmer's point here seems to be that people who earn from investments rather than wages aren't necessarily the main group he's trying to protect from tax hikes. Now, what about those who just have a bit of money in stocks or a rental property on the side, right? It turns out that Starmer's spokesperson clarified this part. The spokesperson mentioned that Starmer's comments were really about people whose main income comes from assets. So, people with only small savings in shares or maybe a bit of rental income aren't necessarily who he's targeting. It's more about people with substantial earnings from these kinds of investments. The next question, of course, was whether taxes on people with these kinds of incomes, shares, property, and all that would actually go up. And that's where it gets interesting. Starmer didn't give a direct answer, but suggested you could give me all sorts of examples, but I'm just defining what I mean by working people. I think he's trying to say that his definition of working people doesn't automatically imply specific tax rates or policies. It's more of a distinction he's trying to make about the different kinds of income sources people have. Okay, so this debate over working people and tax changes ties into something bigger. Recently, there's been more talk on whether the government will raise national insurance on employers, which is a big deal for businesses and employees alike. Reporters even asked Starmer to explain his definition of working people while he was on a trip for the Commonwealth Summit in Samoa. Here's what he said: he's thinking about folks who work for their living, who might have a bit of savings, but can't just write a big check. If things go south financially, his focus seems to be on people who are, relying on their job income rather than wealthy investors who can afford to live off assets. Starmer and the Chancellor, Rachel Reeves, have already warned everyone that the upcoming budget is going to involve some tough decisions. It's not just words, they're preparing the public for some significant changes. In particular, Starmer hinted that capital gains tax (CGT) on shares and other assets could be increased. This would be a shift from the current rate of up to 20%. The government is contemplating raising this by a few percentage points. Right, so it sounds like there's a decent chance taxes on stock and other asset sales could be going up. But here's the thing, although they're considering raising CGT on shares, the government is reportedly less inclined to touch the CGT on property sales. And there's a good reason for that. They're concerned that increasing this tax might actually discourage property sales, which would then reduce tax revenues in the long run. Property tax rates were recently lowered by the Conservatives, with the top CGT on property sales reduced from 28% to 24% in the last budget. So they're likely weighing the pros and cons carefully before making any changes to this particular tax. Meanwhile, Rachel Reeves, as Chancellor, is also considering revising the rules around inheritance and gift tax. Right now, only about 1 in 20 estates in the UK ends up paying inheritance tax, so there's been talk of making the system stricter. It's an interesting move because inheritance tax is always a sensitive topic. People feel strongly about it on both sides, especially as it involves what they leave behind for family. One other key figure in all of this is James Murray, a Treasury Minister. When asked if a landlord counts as a working person under Labour's Manifesto, that pledge not to increase taxes on working people, Murray responded by saying that working people means those who actively work to earn their income. During an interview on BBC Radio 4's Today programme, he reiterated that they've been clear in their manifesto about this definition. But journalists pressed him even further on whether landlords specifically count as working people, especially in light of Starmer's statement that people earning mostly from assets wouldn't fit his definition. Murray kind of sidestepped the question, focusing instead on the source of people's income. Basically, he kept emphasizing the Labour Party's stance about where the income comes from, suggesting that any tax policy changes will align with what Labour originally pledged in its manifesto. So what's the takeaway from all of this? Well, it's that the government is walking a tightrope here. They're trying to stick to their promise to protect working people from tax increases, but they're also setting the stage to potentially raise taxes on income from shares and property. Starmer's made it clear he sees a difference between those working a day job and those primarily making money off assets. And yeah, while this distinction might help some people understand Labour's approach, it also raises questions. Like, what exactly qualifies someone as a working person, and will the government actually follow through with these tax changes? In any case, the public response will be telling. People might appreciate the nuanced approach of not hitting working people too hard with taxes. But on the flip side, those who've invested in shares or property as part of their financial planning could see this as a potential setback. It's an issue that's going to affect a lot of people differently, depending on where their income comes from. So yeah, all eyes are on the budget announcement next week to see just how these tough decisions play out.
Thanks for watching our video. Please hit the bell icon and subscribe the channel. Thank you.